Good morning, everyone. This is Mortgage Pros 411. I'm Audrey Boissonou with my co-host Kevin Casey. Say that name 3 times fast. And today we are joined by Julia Gordon. Good morning, Julia.
Hi, everyone.
Good to see you. So Julia comes to us as the Assistant Secretary for Housing and Federal Housing Commissioner at the U.S. Department of Housing and Urban Development. Is that a correct title for you, Julia?
That is a correct title. It is a long title, but you know what? There's longer ones elsewhere in the
Oh my
government.
God.
No, we could not fit that on the 1003. That would not be an acceptable job title. There are only 25 spaces on a 1003 for your job title. So tell us a little bit, because we hear FHA, we hear HUD, and it gets a little confusing sometimes. Like, okay, so Marcia Fudge was the head of HUD, and then tell us how it all fits together, and then what happens next.
So the Department of Housing and Urban Development, HUD, is one of the executive agencies, part of the president's administration. And within HUD, there are multiple offices. So the Secretary of HUD runs the whole thing. That was Secretary Marcia Fudge. She left, so then you get someone acting. In our case, the person who had been the deputy secretary, whose name is Adrian Todman, who's a longtime houser who's worked at HUD through, multiple cycles. Then there are a number of offices within HUD. The biggest office in HUD is the Office of Housing. That's the one that, I have the honor of being in charge of during this administration. I think it's important to note that all of the executive agencies have two types of employees. They have career civil service employees, which are the bulk of the people who do all the real work. And then there's a layer of political appointees that comes and goes depending on the administration.
Right.
I am a political appointee. I'm what they call a PAS appointee, which stands for Presidentially Appointed and Senate Confirmed. There aren't that many of those in the government, and there are fewer of them than there should be, because so few people these days are able to get through Senate confirmation.
I believe congratulations are in order.
Yeah, congratulations on that.
I have to say, I've really, really loved, I've been in this seat now for about 2.5 years, and it's absolutely been the best time of my life. I love this job. I love this team. I love this organization. So under the Office of Housing is the Federal Housing Administration, FHA. FHA has 3 portfolios. The single family portfolio, which everybody who's listening right now knows about, the multifamily portfolio, which lots of people listening right now know about, and the healthcare facilities portfolio, which practically nobody who doesn't work in that field knows about. Do provide mortgage insurance to hospitals and residential care facilities.
Oh, wow.
Interesting.
Really?
So that's just within FHA, but I have a whole bunch of other things I do in my job. One is HUD's rent-assisted portfolio of rental properties, multifamily properties that receive subsidy from the government through the program everybody knows as Section 8. But this is money that doesn't go to an individual person's voucher. This goes directly to people who own and operate multifamily properties, so that they can keep units affordable for very low income people. So, we have this whole portfolio. It's called project-based rental assistance. That also includes in it a pot of funding for housing for seniors and housing for people with disabilities. And all of that also is part of the Office of Housing, even though it's not FHA. Though sometimes, of course, a property might have an FHA insured mortgage and also be part of the rental assistance program. Beyond that, there's also two other really important things that we run here. One is the Office of Manufactured Housing Programs, which runs what we call the HUD code, the Federal Building and Construction Code for Manufactured Housing,
Okay.
and the Office of Housing Counseling, which for those of you who work with housing counselors, that program is run by HUD, but of course our counselors provide counseling for people seeking mortgages or who are homeowners, and they don't have to be affiliated with FHA. It can be conventional mortgages or VA or whatever. We also provide counseling to renters as well as to homeowners. So that, and then beyond all of those things in the office, of course, we have, you know, folks who do operations work. We have a risk office. We have an office of finance and budget, because running a, you know, $1.5 trillion portfolio takes a lot of people working to keep it up. So, you know, within this office, we have around 2,600 employees, and we do a lot of things. So my job is never, ever boring. But even though my job is broader than FHA, everybody's favorite thing to call me is still Commissioner Gordon, which is why you see the Batman shelf behind me.
I was wondering about that. I
Oh
thought
my
maybe
God.
it was a hotline to Batman when you needed a little bit of help.
Okay, so I'm not even going to try to understand how on earth you've been in this office for 2.5 years. That I can't imagine the amount of time it takes to get up to speed. And here we are with a new administration coming imminently. And what happens with you in your position after that?
Well, sadly, what typically happens with political appointees is they are replaced with political appointees from the other party. Now, in the past, sometimes people were asked to hold over while the new administration got people in place and got up to speed. For example, President Obama held over Commissioner Brian Montgomery, who was a Bush appointee. Starting in 2016, that sort of holding over thing kind of went away. We've gotten very positional in our politics. I'm not sure why, because the jobs that we do here in the Office of Housing, I mean, sure, I have, I have certain views that you would probably see as partisan, but the vast majority of what I do is operate the world's largest mortgage insurance fund. And yes, I know a great deal about it that I didn't know coming in, and it probably would make sense for them to hold me over. So they're certainly welcome to ask me to do that. I would say yes. But for now, I'm assuming that I leave the building on January 20th at noon.
Wow.
Wow. And then you will be added to the unemployment numbers.
You know? I mean, like,
We
there's
follow closely.
I don't know who's on this phone, but I might be job hunting, so.
You know what? I mean, why not put it out there, Julia? I mean, here is just as good as anywhere else, right? So, okay. So FHA has accomplished a lot in the last few years. You did a few things, and I'd like you to take a few moments to talk about those initiatives that you've accomplished over the last few years, but also be thinking about, what would be next for FHA? Because certainly we've had some listeners chime in with some ideas and some questions for you. So we'll get to those, but tell us what you feel best about and what you are most proud about accomplishing the last 4 years, or 2.5, I guess.
Well, so much we've done that I feel great about. And I do want to recommend to everybody to look at 2 reports that we just put out, and maybe Chuck or somebody could even drop them in the chat, or we can share them.
If he emails to me, if he sends them to me, they can be embedded in our YouTube channel into this. So that'll be great.
So one is, every year we are required to submit to Congress an annual report on the state of the Mutual Mortgage Insurance Fund. That's the insurance fund that handles single-family mortgages, both forward mortgages and HECMs, reverse mortgages. That is an annual report whose flagship number that we share is what we call our capital reserve ratio, which is what it sounds like.
Yeah.
And Congress requires that we maintain a ratio of at least 2%. There was a time right after the big financial crisis that FHA went below that threshold. But subsequently, FHA has actually been an extremely well-managed program for the past number of years. And you'll see in this annual report that our ratio is at actually 11.47.
Oh, wow.
So, that's like practically 6 times than what's required. I think there is no financial institution out there that wouldn't be, that wouldn't feel very well capitalized in this situation. But particularly for us as a organization that has the full faith and credit of the United States government behind us, that's a very high ratio.
Yeah, that is great, especially with a slow economy.
Well, to be honest, what the ratio includes a number of things. One is the value of all of the collateral backing our insurance. Of course, home price appreciation has helped that number. So that
Okay.
worked in our favor.
Do you take the price of the collateral at the time of funding, or do you keep track of it throughout the years in your portfolio? Like, do you take current values, or do you take the values that when it entered your portfolio?
Like everything that the modeling does for this report is over the full term of the loan. So we have to look 30 years ahead. We make projections. They're based on the presidential economic assumptions. We don't necessarily make up our own macroeconomic numbers. We take the ones that the rest of the government is using. And then we project out. So when I came into this seat, the number wasn't quite that high, but it was headed there. And I felt like we really needed to consider reducing mortgage insurance premiums. Now that took a while to get done for reasons that, that involve many other parts of the government, not just FHA. But we did drop the mortgage insurance premium quite significantly by about 1/3.
Right.
In March of 2023. That's definitely one of the most important things we've done in this economy. While inflation has slowed down now, it's pretty rare to see prices actually go down. And
Right.
so we're able to actually drop that price. And every time we put out this report, we're looking to see how we're doing. So for us, we wanted to give it a while after that first cut to see how are we doing. And we are doing well. And so I notice in the chat a bunch of people asking whether there will be more cuts. And I will say, while we look at many different factors in considering a cut, not just at the MMI ratio, it's probably time either for us or the people who come in after us to consider whether some other kind of cut, whether it's to the annual or the upfront or the life of loan. Those are the types of things we would look at now that we have the data that we've gotten from the annual report.
Well, that was the first thing that pops into my LO brain is, okay, can we cut again and life of loan, right? Because life of loan is not popular, although I will say that we've had the pleasure of having Julianne Joseph on our show here, and she educated us on a few things. Number one, FHA is not a mortgage company, it's an insurance company. Number two, you guys look forward, not backwards. So just because things are great, how are they going to look in the future? And then, so she had walked us through how complicated that life of loan decision was. And at the time she was on, she didn't think that that was going to change, but it's been a while. So do you think that's on the table as a possibility?
Well, so, we get these requests all the time, and I think it would be irresponsible for us. We're going to do some analytics now. Now, like we said before, I only have, about 60 days left in this chair. So probably, we will take a look while I'm still here. They may need to take a look when the new team comes in. But I think you're absolutely right that, every year after we do our annual report, it's a good time to review where things are, to consider whether changes need to be made in the future. I do want to mention a second report for anybody out there who is interested beyond just the single family portfolio. We also put out a very big report called the annual management report that also goes to Congress. And that reviews not just single family, but also the multifamily and healthcare portfolios for FHA, and has a lot more in-depth text about particular policy issues or policy changes that have been made. It's a little less wonky than the MMI annual report, but it also has like an appendix with every possible financial that you might want to look at. As a government agency, nothing's private here. It's all public. We share all our financials. We share out all of the results of the modeling that we do so that everybody can take a look at it. And honestly, we often get great ideas, from the field for things that they want us to look at or change,
We're full of great ideas, Julia. So just, stay tuned. So you mentioned reverse and regular FHA, but you didn't mention the 203Ks. Are they under the same umbrella? And are all of those in the same fund, or are they separate?
Nope. Everything that is a single family product is under the same fund.
Okay.
Interesting.
So the 203K, which for anybody who may not know what that is, that's our renovation loan product, which I honestly think renovation of the existing housing stock in this country that is aging, and that needs to not only be retrofitted to be more modern, but also to be more energy efficient and resilient. I think that's like this enormous priority of our time, is to work on how we reinvest into the current housing stock. So we actually made a bunch of changes to 203K to try to make it more useful.
I should have told you this before. We did a whole show on this a couple weeks ago. So we covered, people can go to the YouTube channel and find that episode where we discussed all of the changes that happened. And congratulations, by the way.
Yeah, that was congratulations on that. That was good.
Monumental. And I mean, I didn't even realize that it had been, that some of the numbers had never changed ever since the inception of the program, which is shocking. And the fact that you guys not only upped the numbers that we're now able to use, but that you have built in additional increases in the future. So we're not gonna have to wait another 40 or 50 or 8 million years to, get up to speed again. So that's a biggie, Julia. Thank you.
I also want to mention another product. I don't know if this came up on your show. Do you know about 203H?
No.
I've walk us through it. I have heard of it, but yes, walk us through that.
This is a more obscure product, but I think it should become much less obscure. And the reason is it's a product designed for people who have experienced a natural disaster. And we all know that we're having more of them and that they're more intense.
Yeah.
And more people need to really readjust their situation after experiencing a disaster like that. The 203H disaster product is our only product that's a 100% financing product. And what's important for people to understand about it, beyond the fact that you've just had a disaster, so you probably you know, you haven't fully settled all the insurance situation and you've lost a lot of your savings probably. That's why you can get into this without a down payment. I think something that's really important to note about it is you don't have to rebuild in the exact same spot. Or, you know, I think it's
Wow.
important for people to know that we have products that can help you after a disaster if you say, you know what, there's going to be a wildfire here every 3 years, or there's going to be a hurricane here, you know, all the time. And maybe what I want to do is move to a place that's a little less exposed.
That would be really big for flooding more than fires, because fires tend not to come there's a couple areas in California that have fires regularly, but most of them are one-offs, like every 50 years. Because it takes all that long to regrow all that growth that burnt the first time.
Yeah.
But
Yeah.
flooding, I can think of places that flood pretty regularly, and that would be huge.
Well, I was laughing in my head as you were starting to describe it, going, God, does it cover the cost of moving your house? And then you said, well, you could rebuild somewhere else. So again, these are things that, you know, we'll make a note of it. We'll take a dive into the H and make sure that we have more information for people, because that's really valuable in a lot of these areas.
Mhm.
Yeah, great. I'm glad to hear that you guys are innovative, that you're thinking about what's really happening on the ground. And this is the messaging we've received from FHA in the last, you know, few years. We've been doing this show 4.5 years. And when we started having FHA on, we were so impressed and hopeful, because there is a connection between where you're sitting and where we're sitting, which is really important because we're the ones who are touching the consumers, right? So, yay.
FHA is basically one of the original public-private partnerships. All I do is make mortgage insurance. I don't make mortgages.
Right.
So, you know, without what you do, nobody would care what I do. So I've found that to be such an important relationship, and what we've tried to do in this administration, and I hope this continues past us, is really to be much more transparent, to solicit feedback, even when we're not legally required to. Like, of course, if we do a rulemaking, we have to put it out for public comment. But we've tried with every mortgagee letter, or every, you know, substantive mortgagee letter, to put that on our drafting table so that we can get the details right, because it's so important for you to feel like you can work with us, and that,
Right.
you know, that things aren't like missing each other, you know?
Right. So let's talk for a minute about condos. Condos are a huge issue these days. Fannie and Freddie have imposed some fairly strict guidelines around financing condos. And when I say fairly strict, I mean like strangleholds. And we have certain states like California, I just read about Florida, who've enacted a bunch of laws around condos and making sure that things like balconies are safe, etc. And when you combine all that with insurance premium requirements and deductible requirements and reserve requirements, it is getting harder and harder for the consumer to manage their condos. And the folks I worry about the most are the ones who don't have a zillion. They're not living in the $2 million condo in a high rise in San Francisco.
Yeah, they're in the low end ones.
They're the less expensive properties where if they are hit with a special assessment of 60 grand, they're going to have to, they'll lose their property. So I just worry constantly. And FHA used to have spot approvals. Now they're called, you brought them back, thank God. Now they're called, what are they called? They're called something else, not spot approvals.
Yeah, I'm not sure exactly.
Okay, well, you can get an approval. You don't have to get a whole
Yeah.
complex approved with FHA. You can just get one unit approved. So a single, there's some special name. Anyway, with all that being said, tell us what the conversation is on your end around the condos, HOAs, insurance, like all that's going on there.
So my team tells me it's called single unit approval.
Thank you. I thought single was in there. I could not remember. Thank you, team.
So, you know, condos are one of the most important challenges we face.
Yep.
We all know that for people just getting into the housing market, as well as for seniors, condos are an incredibly important source of attainable housing.
Mhm.
And, um, what's challenging about them is less kind of the specific details of the Fannie or Freddie policies or the FHA policies. What's challenging about them is they are really a form of hybrid living, where you do own your house, you do own the place that you're living, but there are collective responsibilities for a
Okay.
larger building.
Yep.
And we know that just from a sort of psychological standpoint, that runs into all of those collective action challenges that you learned about in your psych class or government class in college, which is that it is hard for people to pony up for things that, they may think are not their fault or shouldn't be their responsibility. And that underlies the challenges we have with a variety of hybrid type situations, not just condos. When it comes to condos specifically, and this is something our team, I would say they are continuously working on condo policy and thinking about ways that, that they can make it work better and be more accessible. But there are so many thorny issues to work through. And, of course, the, situation in Florida where the Surfside condo went down was a big wake-up call for, in a lot of ways throughout all parts of the industry. Because really, we all believe in safety first. And you never, as an insurance company, you want your collateral to be in good shape, but above all, you want residents to be safe. And so these things are complicated. We've often been asked to do things like on the single unit approvals, which now I'll stop calling spot approvals.
Me too.
That was something people really, really wanted. And it happened and didn't get as much uptake, I think, as maybe was originally projected. This is something that I'm worried will happen also with things like 203K. You sometimes think a policy change will fix a problem, but the problem may be deeper, more complicated than policy can necessarily account for. So the single family team, I know, like, condos is sort of one of the next things for a deep dive by this team. I don't know how much of it we'll get to do before I'm gone, but the team is really, really committed to this issue and very open to input and thoughts.
Yeah, it is. I feel like, number one, I've really gotten on the Department of Real Estate in California a few times because there's no oversight for HOA management companies and for HOA boards, etc. So, I mean, just like our federal government, everyone kicks the can down the road. They don't want to deal with what's right in front of them or what's coming. Until it slaps you across the face, which is what's happening right now, is everyone's getting the big old slap and you don't deal with it. So then all of a sudden, and frankly, a lot of HOA boards are made up of the people who have
Volunteers.
time. They have time. They don't have knowledge about construction or financials or reading budgets or understanding reserves. They don't know all that. And then
They don't even know all the rules that they're supposed to be following.
they don't. And then the management companies are an entirely different subject, which I will spare you my opinion about that because it is egregious what happens there. So it is so complicated and there needs to be oversight into these HOAs and their management companies because that's how we've gotten here is delay, 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 and just push it away, or not address it at all. And then here we are. And for a buyer coming in, they're literally I've seen this recently. The Realtor says to the buyer, I sent you the HOA docs, review them and let me know if you have any questions. I'm like, are you freaking kidding me? My head would explode if you said that to me, and I'm in the business. So thank God I caught that one. And I said, okay, you and I will talk about them. But that doesn't happen with every transaction and every borrower. So it's not even that these borrowers don't want to address this. They have no idea what could potentially happen. It's a problem. So anyway, I don't know how to address it either, especially in the land of click, 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 disclosures where no one's reading any of that crap. Everyone's just ticking a box on a compliance checklist. So it's complicated, but it's something we all need to be really focused on, I think.
A lot is on the states and localities, as well as just, the management in each instance really has to make sure people understand what they're getting into, understand the variable costs, the need for capital investment. We all know what's happening with hazard insurance costs these days. So people need to be really well informed when they're doing what they're doing. But I think that condos are such an important part of our housing stock, especially in some geographies, as kind of that entry-level housing, that we can't just throw up our hands and say, oh yeah, it's just all a big mess. We have to keep working. And I do see someone asked in the chat, how can we speed up and streamline the process? I'll tell you the answer to that. Well, first of all, we're looking at ways to do, we're always looking at process improvements. There's continuous improvement here, but there are two things that hold us up from improvements sometimes on things that you may think we go slow on. One is the number of staff we can hire, and the other is the state of our technology, which, as one of my colleagues like to say, is sometimes, the best that the 1990s have to offer. We are in the process of an extremely ambitious and wide-ranging modernization effort of our technology. We've already done some great things in FHA Catalyst, for example, that I think really bring us into, modernity. Inside the Office of Housing, we have like 45 different systems. And,
Wow.
a handful of them, like 7 or 8, are really, really antiquated and obsolete. And so we want to fix them all, but our IT budget that we get from Congress is
$4.50.
multiple smaller than any other company anywhere, whether it's Fannie or Freddie or whether it's a private company. It is crazy what a small percentage of our budget the IT is. And same thing with salaries and expenses. We don't pay those out of the quote, profits of FHA. We don't get to sort of stand on our own bottom the way a private company does. We get that IT funding and that salary funding from Congress through the federal budget.
Mm-hmm.
So
That makes sense.
that can really hold us back sometimes in terms of what we're able to accomplish. And I, always try to make sure that people in the industry understand that relationship, that we operate partly out of these government appropriations, even though we have a sort of net positive return to the government fisc. Like, they make more money off us, generally than they spend, but we're not like a self-contained unit. We're part of the federal budget.
Okay, so I'm a little scared that Elon Musk just popped into my head. Like, do you think we could tweet to him and get him to put IT upgrades on for FHA on his list of things to do? Because certain, I'm just
Well,
that was a joke, Julia. Laugh, geez, Louise.
I
Oh God. Okay.
There's so much I can't say on this topic.
Oh
But,
my
you
God,
know,
sorry.
I, I feel my job is to make sure people understand how we,
Yes.
and then they can choose how they use that information.
Well, I have to say it is helpful when we talk to people like you and Julian and we learn things like that. Cause honestly, I hadn't connected the dots back to, oh, it's the budget. Duh. I mean, it's so obvious. I don't know why it didn't, it didn't seem more obvious. So anyway, we had heard you were well on your way to like improving the tech at FHA. You're getting there. That's kind of the
We're
open.
actually getting there. We have like a full-on strategic plan for the next 10 years. We have a roadmap. We're checking things off, constantly. On the multifamily side, we just today debuted the new Plus system, which is something that we've been waiting for I think 10 years. I think that's not exaggerating.
Oh my
So we're getting stuff done. But it's a big project.
Oh my God. All I can think of is you've got 11 times the amount you need or, in your reserve fund, yet the technology is decades, in the making. And why can't we? Okay, I just won't go there.
Yeah.
Good God. Okay, let's talk about something else. Let's talk about FICO 10T and Vantage because we are hearing, I mean, we've been hearing, I've stopped being excited about it or worried about it just because it's been a year and a half since we
A
started.
year and a half of it's coming in back in 3
Oh,
months.
yeah, a year and a half ago, we were like, it's imminent. And now we're like, okay, yeah, whatever. But we hadn't heard that FHA had made a comment on whether or not you would also at some point, also in the future, God knows when, adopt Vantage and or FICO 10T.
Well, because of the way you all work with us and because of the way we use the GSEs, AUSs,
Right,
we believe that if this is where the FHFA and the GSEs go, it's going to be important for us to be ready to go there too. And so we've been doing a ton of analytics and a ton of getting ready. But this wasn't necessarily driven by us. And
right.
so we do expect with a change of administration, let's just put it this way, a change of administration rarely makes anything go faster. That tends
Right.
to be when things slow down.
Right.
So, I don't know where the new administration will necessarily go with that. I think what's important from an FHA perspective is that we are ready for whatever happens because we don't ever want someone to not be working with FHA because of something we didn't get ready for. So we're just here like doing the things we need to do, and not, we're not making predictions for the future. That will probably come out of FHFA.
Okay, so they're kind of the leader in that, but you certainly have done a lot around manufacturing, housing. You've done a lot of changes, upgrades. I mean, you're definitely moving forward. So that momentum is important, obviously. Tell us your thoughts around automated appraisals. Do you think, I mean, FHA has a very specific way with the case numbers being assigned to properties, et cetera. Do you think appraisals will be something that we adopt? Do you analyze them the same way that GSEs do? I mean, do you scan them
Not
and do you?
exactly the same way. We don't have exactly the same tools that they have, partly because of the aforementioned, IT situation.
Right. Don't forget that.
We've been definitely modernizing, obviously with our electronic appraisal delivery and using data from Veros, we've been modernizing how we approach the whole issue of appraisals. It is something that I would say isn't like on the top of the list to completely change the way we do things. There are lots of tweaks, not just in sort of automated valuations, but throughout the appraisal process and who we use as appraisers and all of that. There are things that we have on the drawing board, et cetera. But there is no doubt that valuation sort of lies at the heart of what we do here when we're writing mortgage insurance. And so, we've done a lot of things, not only to try to get accuracy that we can get from whatever combination of computers and human beings, but also to make the appraisal systems more fair, because we know that there's been a lot of racial discrimination in appraisals over the years, that really holds a lot of communities of color back from seeing the kind of home price appreciation gains that other neighborhoods see. So we've been working on this whole of government interagency task force called the Task Force on Property Appraisal and Valuation Equity. And you may say, what do those words mean? And the answer is, they come out with a cool acronym, which is PAVE. This is the PAVE Task Force. And, one of the biggest accomplishments, I think, of that task force is that FHA and FHFA are now working together through the good auspices of FHFA, which has also better technology than we have, to aggregate that data and make it available in a way it's never been available before. Appraisals has been one of those areas where you can do whatever you do, but you're kind of shooting blind because you don't have that kind of rich data source that we have, say, on the origination side from HMDA. So now we're building that. I think that's going to make a really big difference. We also, as y'all may know, have here at FHA, and FHFA has done this as well, we've implemented new reconsideration of value requirements so that borrowers know how to raise their hand if they have a concern that their appraisal was inaccurate or biased. But we're kind of leaving it to the individual lenders to figure out, exactly what they're going to do there. We're not super prescriptive, but it is really important to make sure that valuation is fair. It's important for us as an insurer caring about the value of our collateral, and it's important for our mission to try to attain home ownership for many communities that have been left out for a long time.
So, okay, so moving to a different subject, reserve ratios. There was a comment in the chat. How do your reserve ratios compare with private mortgage insurance? Do you know the answer to that? Is it comparable? Is it higher, lower?
You mean like that ultimate number? So we
Yeah.
do our accounting differently. So you're not going to be really comparing apples to apples.
Okay.
But for public companies, you can look and you can get a sense of, of how we stand there.
Okay.
We're quite well capitalized at this point.
Right.
We don't have the government standing behind them.
Oh, no kidding, right? So, and we, I think a lot of us had a greater appreciation for the GSEs and their role, and FHA during the pandemic and lockdown, when all of a sudden, non-QM went away, jumbo went away, all of a sudden, but these government backed entities, not owned, were really important. So I'm going to just take a minute because I totally got so excited about having you here that I did not touch on anything that was going on in the economy or anything like that. So just a little heads up for everyone. The Fed is feeling a little less confident about lowering the Fed funds rate again at their December 18th meeting. They're really watching the inflation numbers, which we know are probably not going to look better until January, because the replacements that they are
coming off low numbers
this month, next month, are really super low from last year. So this is a great time for you to explain with real life examples of how the Fed does not control mortgage rates. Okay. We try to explain this to people. They don't get it. And this is the time where you are able to show them, look, So they lowered 50 basis points and they lowered 25 basis points, and rates have done nothing but go up since then. So great learning opportunity for you and your borrowers. This is the example. So just hang in there, guys, and just go close loans anyway, because can they afford the payment? Does it cash flow? Those are the questions we should always be asking, not, what is the rate? Can you afford it? And we're not hearing anything at this point making us believe that we're going to be in the fives anytime soon, and definitely not fours, threes, or twos, because we don't want a catastrophe. So get over it, go get some loans, help your borrowers qualify, and know that the appreciation levels, although they're leveling out, they're continuing to level out. It's a good thing. They're not
Yeah.
down. They're just getting back to more normal pre-pandemic healthy appreciation, not unhealthy appreciation at some ungodly, unsustainable amount. So, we had,
Audrey, remember yesterday we were talking about this client I just got in a contract where we did the analysis for the borrower because they were all freaking out. They were paying $4,000 a month in rent. They didn't want to go to $5,500 to buy a house. And then we did the math of, well, in the next 9 years, your $4,000 a month will be, and we did the math on that. And then we did the math on, well, your place will appreciate by X according to Fannie Mae's guidelines for the county. And it was like $600,000 gain versus a $480,000 loss. And it's like, oh, which one would you rather have? And it's like the instantaneousness of their decision was amazing. Within seconds of me presenting those numbers to them, they said, yes, let's go ahead, do the loan.
once I pinned Kevin to the wall and made him actually work on details, because his client was an engineer, and Kevin's brain does not work that way, mine does. So I was like, okay.
That's why I reached out to her.
I'm like, like I have a borrower recently, she was a single mom forever. She had just raised her 3 kids. She had a pile of money that she had inherited long ago and had really taken good care of for a long, long time, but was freaked out about buying a house. And I pointed out how much she's paid in rent in the last 10 years, and she almost fell off her chair. That's what gave me the idea for telling Kevin, okay, here's an idea for your client. Because when they would look at, okay, I just paid, it's literally hundreds and hundreds of thousands of dollars over the last 10 years. And in the next 10 years, you keep doing that, you will have nothing to show for it, nothing. And your rent just keeps going up. So the more we can help people understand that this is possible and make it so that you figure out with them what is affordable, that's the way forward, just in my opinion.
I always think of it as it's not just what you pay, it's who you pay.
It's who you pay
Yeah.
and what.
And I something that I think is important, and I learned this during the course of the financial crisis, is that there's many reasons to buy a home, and the appreciation needs to take a much more lowly place in the consideration. It's that equity building that you can really rely on. You're paying yourself month after month, and that's like saving money.
Yep.
Not what's
It's
happening.
forced savings. It's a forced savings.
So, there's so many reasons to have the stability. My parents didn't own a home. And just the stability of not having to move when someone else wants you to move, as opposed to when you want to move.
Yeah,
Mm-hmm.
it's a big deal. Also interesting to note, MBA, Mortgage Bankers Association, is expecting that our volume in 2025 for mortgage originations, that it will increase to 2.3 trillion, that's with a T, trillion, from 1.79 trillion in 2024, this year. I would just like to point out to the crowd that MBA's projections for this year were much higher than we ended up being having in origination. So they're saying 2.3 trillion from their mouth to God's ear, but who knows, right? So like
We will
any
see.
expectation or any forecast, any of that, it's, the wind could shift and all of a sudden it's a whole different thing, right? So there you go.
Hey, I wanted to take a quick moment as we're getting towards the end here. I was calling a bunch of realtors, and this is the conversation I've been having with them, is because next week is Thanksgiving. And so I've been saying, hey, as you're going around, meeting people and such, topic tends to be Thanksgiving this week, next. And so a great opportunity is there for us to say, hey, who at your Thanksgiving table would like to have Thanksgiving at their new home next year, with them being the hosts? And that is such a great question I've asked over the years. And it's always like, oh my God, yeah, I have my young niece and his new wife coming over or whatever. And I go, yeah, just let them know I would be happy to help them have their dream home so they can have Thanksgiving next year. Or if you're a realtor, you know, hey, I'd be happy to help them buy that house. It's really crazy how it works. So want to share that as we're going into Thanksgiving week. One of my favorite holidays, by the way.
Yeah. Also interesting to note that despite all the changes with the real estate commissions that happened in August, the average realtor commission has barely budged. It's gone from 2.35% average to 2.34% average. So $418 quadrillion later, and huge upheaval in the industry, and there we are. So it'll be interesting to see how that goes. I don't know what you're seeing out there, guys, but it seems in my area, business as usual, as far as sellers realizing they need to have representation on both sides. Everyone needs their own person, and that it makes the most sense in this to have the seller, who may presumably have more assets to share, pay for it, because then they're going to turn around and be a buyer. So it evens out eventually, right? So I don't know. It'll be interesting to see if this trend continues, but so far, what are we, 3 months in and not much of a change? What are you seeing, Kevin?
You know, we'll see. That's all I can do. I'm not going to go any predictions.
No,
Actually, I
I'm
have a
just saying-
question for
no,
Julia.
I didn't ask your prediction. I asked what you're seeing.
I'm saying things are picking up since the election.
No, okay, that's also not what I just asked. I said,
I'm sorry.
okay, forget it. Julia,
So-
as we get to the end of this, what is it you would like to share with us that we haven't already covered?
I mean, there, you know, I do want to talk about my favorite topic. You alluded it to before, which is manufactured housing.
Okay,
And factory built housing, generally speaking. I think in many places, and not just rural areas, suburban and urban areas as well, I do think that the quality of manufactured housing that's being produced today, along with, we've made several updates to the HUD code during our administration. And the last update we just made was the biggest update in more than 2 decades. And we now have things like, you can have duplex manufactured housing, which is one of the most interesting and most, you know, a lot of people are starting to get interested in getting those. You know, the housing has so many modern features, open floor plans, peaked roofs, like a lot of contemporary manufactured housing. If you put it side by side with a site-built home, you cannot tell the difference. And it is both cheaper to manufacture, and in many cases, it can be built in a way so it's very energy efficient.
And it goes up a lot faster.
Yeah, it's not the choice for everybody. It's not right in every place, but we've seen way too many jurisdictions whose land use ordinances kind of just say no manufactured housing because they're thinking about trailers from 1975,
Right.
whatever. And so I think it's going to be, as we try to get, you know, we have to help many families who are not going to be able to afford the median priced site-built home out there. They're just very expensive for a lot of people. We've got to look at alternatives. And we did do the appraisal accommodations for cross mod, by the way. Whoever asked that, that's already done. And this is
hang on, explain what that is.
just the idea that for this particular type of manufactured housing, which is called different things by different channels, but it's the housing that I would say looks most like site-built housing, that you can use comps of site-built homes. And that makes a big difference. So
Wow.
So this is just an area people should be educating themselves about, and we have a great Office of Manufactured Housing here at HUD. They love to meet new people. Of course, our single family team has loan products for manufactured housing, both for those titled as real estate, but also for those titled as personal property. So, you know, go out there and check out what's going on. Every year we do this thing on the National Mall here in DC called the Innovative Housing Showcase. I call it the Housing Petting Zoo. We have all kinds of innovative types of housing, you know, panelized houses that get put up in 6 hours, or, you know, we had one of these duplex manufactured homes this past year, or tiny houses, or whatever it is. You know, stay abreast of what's happening out there, because it's really time for this country to start getting serious about alternative housing.
That's, that we've heard about this thing on the mall. I've never seen it, but I've heard it's pretty amazing. So it sounds like you guys are all over anything that doesn't involve a high-end computer. Is that correct?
Look, we have been laser focused on housing supply. We've been laser focused on access to credit. That's why we did the MIP cut. That's why we did the thing where you can use the positive rental history. That, you know, we're trying to help accessory dwelling units with our new underwriting rule that you can count the rental income and even the prospective rental income there. So there's so much we've been pushing on. We've made a lot of changes. Look at our annual reports and stuff so you can keep up. And, you know, again, when you see gaps, call us up, let us know. Condos is definitely an area for focus in the future. So, you know, I know we're at time. So I just, you know, since you may not get many more opportunities to see me in this job, though I suspect I'm not going to like disappear entirely. I just want to thank everybody for your partnership with FHA and for caring about us and for caring about the borrowers that we want to serve and that you want to serve, the first-time home buyers, the people whose parents never owned a home. It's so important, and, you know, bless you for the work you do, and thanks for the partnership.
We really appreciate it. We so appreciate the people who are in positions like yours, who are willing to have a conversation with us, who understand that we are in touch with the consumer and the borrowers, and we love these people. We want them to have a home ownership. We want them to be in a situation that's good for them and all their children and anyone who comes next. So we are, this should be how it is. Like, we should all be, we're all on the same team in concert trying to work for our borrowers. So we thank you very much. And I am terribly sorry that this is a political situation that would cause somebody who is highly qualified and has done great things, that you are going to have to go find something else to do. So please keep us posted on what you're doing. And please, please introduce us to whoever's coming next. And hopefully, God, we can have a similar conversation with him. So anyway, and
I know you've accomplished a lot.
And your team has been great, Julia. So thank you. Thank you. So everyone, there are loans to do. You learn things today. There are, I mean, the guidelines have shifted. There are so many opportunities. Don't worry about the rates. The rates are the rates are the rates, whatever. Let's move it along and go get some more people into houses. So wonderful. Thanks.